Okay, so we have now the amount of depreciation of 90,000. The interest expense is debited due to discount amortization, and we have the other expense total and goodwill impairment loss. We have now the debit of 3,000. So the total cost of 8,200 based on the consolidated figure, giving us the net income of 211,800. Then the NCI, net income of subsidiary, in entry number 5, we are debiting NCI net income 9,360, which we have to deduct from the net income of 211,800. So the net income that will go to retained earnings is 202,440. Then for the statement of retained earnings January 1 for P company and S company 120, and we have to eliminate net income from above of 196,800 and 60,000. You have now the total net income of 500 as computed downward, 562,440. Then we have to deduct the dividends paid by the parent of 72,000, giving us the difference of 490,400. We have now eliminated S company for the dividends paid. You can find in the book 36,000. Then for the balance sheet figures, we have now the balance sheet figures for cash. We are adding the two amounts: accounts receivable, no adjustments; inventory, 210,000, but we have a debit for 6,000 and a credit for 6,000. Okay, so yan. Now you will notice that the numberings that we have in the debits and credits are only followed, or we are just following the numberings in requirement number 5, where we have the adjustments and elimination entries. So that in requirement number 6, we just follow up and take note that we have the numbers from E1 up to E5. So we now get the inventory for the amounts here. Inventory, we are adding and deducting based on the numbering of the entries in number 5. So we have now the corresponding balances. Take note that your accumulated depreciation of the equipment, initially accumulated depreciation of the equipment of 135,000 plus 96,000 minus 96,000. So we have 135,000 plus 12,000. We have 147,000 for the accumulated depreciation, and we deduct this from the equipment account of 420,000. So that's why in requirement number 2, the equipment account has a balance net of only 273,000. So take note, accumulated depreciation is normally a credit. So if you have to add the two credits and deduct the debit and add another credit. Now, for the accumulated depreciation of the buildings, initially we have 405,000 and we are adding 288,000, and then we deduct 192,000 and 6,000, leaving us 495,000. And the total of the buildings account is 1,044,000 in the upper portion. That gives us the difference of 549,000 buildings to be shown at net in requirement number 2. So for the retained earnings from above, we have now 490,440 as computed. And for the non-controlling interest, number 1, 72,000. Number 2, credit of 18,000. And we have 9,360. Now, these are all based on the entries in our entries in number 5. Entries number 5, where we have the corresponding adjustments and eliminations. So we have now the total. So if we go back to a requirement number 2, after, okay, balik kita sa requirement na number 2, where we are asked to fill up the worksheet. Here in requirement number 2, we have now to determine the following items for December 31, 20x4 and December 31, 20x5 in the consolidated financial statements using the partial goodwill or the proportionate basis approach. So we now have the amounts in the columns for December 31, 20x4 based on our computations in number 6. That's why we are told to refer to number 6 initially for this computations. So for the total assets including cash, accounts receivable, we have inventory, then land, equipment, and we have buildings. Investments already equal to 0. Now we have the total assets of 1,782,600 600 as for the partial goodwill, and the full goodwill of 1,784,850. So we have a difference of 2,250. Actually, we are not adding columns A up to G, but take note that we have goodwill as one of the assets. However, we have not integrated it here. Accounts payable, bonds payable, total liabilities, common stock, and we have the common stock ordinary share, the retained earnings that we have computed above. Then we have sales, cost of goods sold, gross profit, then expenses including goodwill impairment in the amount of 750, because under the full goodwill approach, we have 750 for the non-controlling interest nga goodwill impairment. Then dividend income, controlling interest in net income, and we have the non-controlling interest in net income as computed above under partial and full goodwill. Then we have the net income or consolidated net income. We have a difference of 750. Then the common stock, ordinary share, and the retained earnings, accumulated profit and loss. And we have now the controlling interest, equity holders, so parents, stockholders, equity, then the non-controlling interest of 92,160 as against 94,410. Now again with the difference of 2,250 for the amount equal to the difference above, stockholders' equity and liabilities, and stockholders' equity. Now for the alternative solution, you also refer to the worksheet. 80% owned, partial, proportionate, goodwill. We have the undervaluation of 90,000. Then we have shown the analysis of the equipment and the building accounts, and we now have the amortization and depreciation. And here we have the consolidated net income from the separate operations of the parent and the subsidiary. Then we have the non-controlling interest in net income, and we have the amortization of allocated excess, and we have the goodwill impairment for 3,000. Then the controlling interest in consolidated net income or profit attributable to equity holders of parent. We add the non-controlling interest in net income. We have now the consolidated net income for 20x4. Then the non-controlling interest in net income of 60,000. We have the amortization of allocated excess. So we now get 9,360 for the non-controlling interest. Now the controlling interest in consolidated net income or profit attributable to equity holders of parent, 202,440. And we have the non-controlling interest net income of 9,360. We have the consolidated net income for 20x4 of 211,800. On subsequent to date of acquisition, consolidated retained earnings will be computed as follows. Consolidated retained earnings, then we add the controlling interest, and we deduct the dividends paid. We have now your consolidated retained earnings. Then for the non-controlling interest, partial goodwill, 240,000 is the common stock of S company. Retained earnings, 120,000. Net income of 60,000. And we deduct dividends paid of 36,000. We have 144,000. Then we have the stockholders' equity, 384,000. And we have the adjustments to reflect fair value over or under valuation of assets and liabilities. Then we have to deduct the amortization of allocated excess and multiply it by 20%, the fair value of the stockholders' equity. Then for this consolidated stockholders' equity, that of the parent, and we add the retained earnings as computed above. It's 490,440, and we deduct the non-controlling interest of 92,160. Then we have the consolidated stockholders equity of 1,182,600. Then for December 31, 20x5, the consolidated net income, you have net income from own separate operations 192,000 for 20x5, and we are now adding that of S company of 90,000. Then we deduct the non-controlling interest in net income of 16,560 and the amortization of allocated excess based on the original computations in 20x4. So we finally have the controlling interest in consolidated net income. Then we add the non-controlling interest in net income. Finally, we have the consolidated net income for 20x5. The non-controlling interest in net income for 20x5, net income of S company, and the amortization of allocated excess or goodwill impairment for 20x5 refer to the amortization table above. So we have now 80,400 as computed for the amortization schedule. So we have now 80,400 and finally we have the amount of 82,800. That's multiplying it by 20%, the non-controlling interest net income of 16,560. Then we are now adding the controlling interest, giving us the consolidated net income. On subsequent to date of acquisition, the consolidated retained earnings would be computed as follows. So we have now the consolidated retained earnings. Retained earnings on January 1, 20x5. January 1, 20x5 in the amount of 144,000, that of the subsidiary. Then retained earnings in January 1, 20x4, 120. There's a difference of 24,000 representing increase. Then the amortization of allocated excess of 13,200. We have a difference of 10,800 multiplied by the controlling interest of 80%. You get 8,640. Now for the goodwill impairment loss on full goodwill, 3,750 minus 750 or 3,000 under full goodwill. So we have the difference of 5,640. The consolidated retained earnings of 490,440. Then we add the controlling interest in consolidated net income or profit attributable to equity holders of P4 20x5 of 258,240. We have the total and we deduct the dividends paid P company of 72,000. That's given. And we have now the consolidated retained earnings on December 31, 20x5. This procedure would be more appropriate instead of multiplying the full goodwill impairment loss of 3,750 by 80%. There might be situations where the controlling interest on goodwill impairment loss would not be proportionate to NCI acquired. Now we have the NCI. The goodwill recognized on consolidation purely relates to the parent share. NCI is measured as a proportion of identifiable assets, and goodwill attributable to NCI share is not recognized. The NCI on December 31, 20x5 are computed as follows. So we have now the common stock of 240,000. Then we have the retained earnings of S company on January 1, 20x5 in the amount of 14,000. And we have now the net income for 20x5 for 90,000. Then we deduct dividends paid given of 48,000. Then we have 186,000. That's the retained earnings of S company. Then we have to deduct the adjustments to reflect undervaluation of assets and liabilities. And we have the amortization of allocated excess. And we have now the fair value of stockholders' equity of S on December 31, 20x5 multiplied by the non-controlling interest percentage. So we have now the non-controlling interest partial goodwill of 99,120. Now, for the consolidated stockholders' equity, we have now the common stock at par of the parent. Then we add the retained earnings of 676,680. We have the parent stockholders' equity on December 31, 20x5, and the NCI is 99,120. We have the consolidated amount of 1,375,800. Now, the 80% owned under the full goodwill or fair value basis, the goodwill recognized on consolidation purely relates to the parent share. NCI is measured as a proportion of identifiable assets, and goodwill attributable to NCI share is not recognized. So we have the net income from own operations in 20x4. Then the total, we deduct the non-controlling interest in net income, and we have the amortization amortization of allocated excess, and we have now the goodwill impairment under the full goodwill approach. So we have now the controlling interest in consolidated net income or profit attributable to equity holders of P. We add non-controlling interest in net income. Okay, so we have we are now determining the goodwill. Okay, the common stock of S will the one which will be eliminated. Then we have the retained earnings in January 1, 20x4. We add the net income and we deduct dividends. So the amount of 144,000 stockholders equity. Actually, 144,000 is given in the balances for 2005 x5. So we have now the non-controlling interest under partial goodwill of 92,160. Then in the consolidated stockholders equity, we have now the consolidated stockholders equity. The common stock is 10 par, and we have the retained earnings of 490,000 For 40, we deduct the non-controlling interest. So we have now the consolidated stockholders' equity in 20x4. Then in 20x5, the consolidated net income from own operations of P&S. Then we are deducting the non-controlling interest in net income with the amortization of allocated excess. So we now have the controlling interest in consolidated net income. We add the non-controlling interest in net income, the consolidated net income for 20x5 of 274,800. The non-controlling interest net income for 20x5, net income of 90,000. Then we deduct amortization of allocated excess or goodwill impairment for 20x5. Now we refer to the amortization table above, multiplied by non-controlling interest. So we have non-controlling interest in net income. And we have the consolidated net income for 20x5. In subsequent to date of acquisition, consolidated retained earnings would be computed as consolidated retained earnings of P Company, January 1, 20x5, under the cost model. Then we have the retained earnings of S Company for the amount of 144,000. We deduct the beginning balance of 120,000. We have increase of 24,000. Then we deduct the amortization of allocated excess of 13,200, and we multiply it by controlling interest 80%. We finally arrive at the goodwill impairment loss for 3,000 under full goodwill. Then we have the consolidated retained earnings, add controlling interest. We have now the total, deduct dividends, consolidated retained earnings on December 31, 20x5. The goodwill recognized on consolidation purely relates to the parent share. NCI is measured as a proportion of identifiable assets, and goodwill attributable to NCI share is not recognized. The NCI on December 31, 20x5 are computed as follows. We have now the common stock retained earnings of S Company for January 1, 20x5 of 14,000. We add net income for 20x5 and deduct dividends of 48,000. Then we have the adjustments to reflect undervaluation of fair values, and we have the amortization of allocated excess for 20x4 and 20x5. Now we get the non-controlling interest 99,120. The common stock at 10 par, then the retained earnings, the total of 1,276,680, and we have to deduct. Here we have 99,120, the NCI under the partial goodwill approach, the consolidated stockholders equity for December 31, 20x5. Now for the 80% owned full goodwill fair value in 20x4, the consolidated net income is consolidated net income from own or separate operations of P Company and S Company. Then we deduct the non-controlling interest in net income and the amortization of allocated excess and the goodwill impairment under full goodwill approach. So we have now the controlling interest in consolidated net income or profit attributable to equity holders. Add non-controlling interest in net income. We have the consolidated net income for 20x4 for 211,050. Then for the non-controlling interest in net income, we have the amount of 9,360, but we deduct the impairment loss on goodwill. So the non-controlling interest in net income is only 8,610. We add this to the controlling interest in consolidated net income or profit. We have the consolidated net income for 20x4. On subsequent to date of acquisition, the consolidated retained earnings should be computed as consolidated retained earnings. Then we add the controlling interest. We have to deduct dividends. We have the consolidated retained earnings at the end of 20x4. Then we have to compute now for the non-controlling interest in 20x4. We have retained earnings and net income and deduct dividends. We have stockholders equity of S company on December 31, 20x4, and we have the adjustments of 90,000. Then we deduct the amortization of allocated excess, 13,200. Now we have the same figure in the table above. So that gives us 92,160. And we add the non-controlling interest on full goodwill, net of impairment loss. So full goodwill 15,000. We have to deduct 12,000 on partial goodwill. So we have the amount of 12,000 on partial goodwill. So the difference is 3,000. Then we deduct the impairment loss applicable to the non-controlling interest. There is a difference of 2,250. The non-controlling interest on full goodwill net of impairment loss. Now, 2,250. So the non-controlling interest full goodwill is 94,410. For the consolidated stockholders equity of 1,184,800.